On today's podcast, we have Duran Cesur, the co-founder and managing partner of Atlas Ventures. Duran, thank you so much for joining us on the Reindustrialized podcast. We're so happy to have you here with us today to talk about your journey, to talk about Atlas Ventures, to talk about cool portfolio companies, and we have a lot to get into today. So I would love to start by getting a little bit of introduction on you to the rest of our audience. Can you tell us a little bit about your background and what led you to the industrial space?
Of course. Well, thank you for having me at the podcast, Newton. So Atlas Ventures, we do industrial tech investments. What it means is these physical legacy industries that have been historically under-digitalized, under-VC invested, typically that are going through decarbonization processes and megatrends like reshoring of supply chains in Europe, etc., etc. So we're primarily looking to invest in energy, manufacturing, transportation, heavy industries type of domains, in developing European ecosystems, in early stage startups. The way I ended up doing this is over the last 8-9 years, I ended up setting up 2 industrial tech corporate VCs, initially on behalf of a family-owned South African group, UK headquartered, with activities in the UK, US, Australia, and South Africa. And those guys were active in areas like mining, transportation, offshore wind servicing, oil and gas servicing, etc. And we were looking to invest in areas like energy, water, materials, Industry 4.0.
Was that focused specifically in the geographies that they operated in, or was that geography?
It was mostly UK and Germany focused, okay. So Western Europe, I'd say. And then afterwards, I set up and managed the corporate VC of a tier 1 automotive supplier, a Turkish group that manufactures wheels and car batteries. There's a logistics business as well. And again, geographically, we were focused on the UK, Germany, a little bit of Turkey as well, and in very similar domains. So that's the background. And then it led into us setting up Atlas Ventures about 2 years ago.
And before you got into the work of structuring these venture capital funds for various sort of industrial conglomerates is what we'll call them, because they have lots of different industries that they function in. Like, what was your background before then?
Yeah, look, the personal backgrounds, born in Bulgaria, grew up in Turkey, studied in the States. Then I moved to London and started my career in financial services at a company called FactSet Financial Data Provision. Then after a few years, I went to INSEAD and joined BCG. So went through that strategy consulting route. Mm-hmm. And after a couple of years, I did some strategy work for another public data provision business, after which I got into VC. So actually prior to VC, I was more in strategy and financial services. Mm-hmm. But I've studied math in university. I did a lot of sciences in high school. I really enjoyed these kinds of things. And once I got into this industrial space, I found myself really enjoying what I was doing. The physical element of it gave me sort of like additional intellectual, joy.
Meaning, when you say the physical element, meaning that the fact that there was like something tangible.
Yeah,
okay.
Exactly. I mean, financial services, great. Something needed, but I did like the fact that we would go out to a factory and like see how things are being manufactured,
or there's like a pipeline that didn't exist and now exists, or exactly. Like a refinery or something.
Exactly. Yeah. So I found that element quite interesting. A lot of things that we look at in industrial tech, I mean, the digitalization technologies aside, especially if you're looking at more decarbonization type of stuff. Mm-hmm. It's all very sciencey as well. There's a lot of chemistry involved and so on. So I found it very intellectually satisfying, you know.
Would you consider yourself to be a scientist at heart? Is that the way that you think about evaluating the world? Are you more like evidence, experiment based thinking, or?
I mean, I wish.
Okay.
In hindsight, sometimes I started thinking I should have studied maybe engineering as opposed to math. it's math does get quite theoretical at some points. I enjoyed it, but I also really enjoyed problem solving, actually. So
you went to a very similar school as me. I saw for undergrad, which I also took a lot of math classes. And at some point I was like, wait, is this writing or is it math? And I kind of hearkened and wished for those days where, it was just a problem that needed to be solved rather than trying to prove whether or not division is real.
Yeah.
So I could definitely identify with that experience. With respect to like how you have thought about transitioning into the world of venture from where you were, like, I'm curious, what was that step like? Obviously being there, working in the financial sort of departments of these large industrial conglomerates, as we'll call them, is the step then, okay, I'm curious about the tech or where the questions coming in. I'm just curious, like how do you cross that bridge into sort of setting up a fund on their behalf?
Yeah. I mean, look, sometimes people ask me how I got into VC, and often I tell them, from what I observe, there's no set path. And I think a lot of people find their way in through different routes. In my case, when I started my career, I first did a double major at uni. So the other one was econ, so I went to finance, financial services, let's say. I became aware of things like PE, VC type of investment banking, etc. And at some point, I started becoming more interested in an investment role as opposed to an advisor role. And I always saw maybe that experience at BCG as a step towards getting into VC, but frankly, I didn't really know how that would have been. I didn't necessarily see a direct path. And coincidentally, I got this role where this industrial group was planning to set up their CVC, but also they needed someone to lead their strategy. So I joined them as this like dual role, head of strategy and the first person in their CVC team. And that's how I got into CVC.
And once you start, obviously the roles start to flow, but it's always landing that first role.
Exactly. And look, at BCG, for example, I quite enjoyed what we did, but it was advisory at the end of the day. Yeah. You do your project at least as a consultant.
Then you leave.
You leave. Whereas within VC, you put your money where your mouth is, so to speak, and that actually gave me a lot more, I guess, embedded interest in the success of the companies.
And you get a chance to, as someone who also formerly worked as a consultant, one of the issues that I always had is like, I feel like these recommendations are great. Like, I'm smart. I put all my time and effort in this, and then you never get a chance to see whether or not the theses that you've had actually come into fruition. Yeah. Whereas with startups, if you make, recommendations, if you have, perspective that you think should be followed, get a chance to stick around for long enough to see whether or not your hypothesis was correct. And that is a whole different kind of feeling of satisfaction. So let's move a little bit into the industrial space. Obviously, you have had this experience working with these conglomerates in this way. I'm curious, like, how you all used the experience at these places to develop the thesis of Atlas Ventures. Like, what are there particular elements within the industrial world do you feel more comfortable with, or that you are more excited by?
Yeah, I mean, there are some sort of like domains that we're excited about, but if I take a step back, first, one of the things that we noticed was, maybe with the exception of the DACH region, in particular Germany, we felt like there weren't enough industrial tech investors out there.
Do you feel like there are a lot of them in DACH?
Not necessarily positioning themselves as industrial tech, but
investing in those kinds of companies.
Precisely. Okay. It's more like it's in Germans' DNA to invest in industrial technology, so to speak, right? Whereas I felt like, let's say, because I live in the UK, I could observe more closely. An industrial tech company, seed stage, approaches these generous seed funds, great funds, but often, especially until recently, they would not show a lot of interest. They were still mostly chasing DevOps, fintech, consumer-related things, or like generous SaaS, etc. And even today, there's a lot more interest in themes like European resilience, as I mentioned, or AI, and then applications of AI into industry. But I feel that a lot of these investors are still sort of building those networks or value add propositions to startups from an industrial perspective, or maybe building teams that can assess them within the industrial context. So it just felt like there weren't enough players in late seed stages. There are a few larger pan-European players, like Speed Invest has a bucket that invests in seed stages. They have an industrial tech allocation, or the likes of Metrowave, Emerald, etc., who sometimes invest in seed, but they also like to invest in Series A. But it's a handful of players.
Yeah.
So that's the niche that we tried to carve ourselves when we went for this, went for Atlas Ventures. But beyond that, what we're observing is, and if you look at our portfolio, we seem to get excited a lot about, of course, applied AI into industry, robotic automation, and decarbonization these days. So those are the three main buckets of themes that we try to invest in.
And to sort of dive into each one of those themes, you said decarbonization, AI application, and robotics, right? Like when you look at decarbonization, are there particular areas? Because it's such a broad space, right? Decarbonization could mean, switching a logistics vehicle from internal combustion engine to electric, or it could be, cement that removes carbon from the air, or, natural or fuels that are zero emissions. Where within that space of decarbonization do you see there being the most opportunity, or have you seen the most exciting startups to date?
Yeah. I guess one thing to emphasize is that this is one reason why we tend to talk about sectors as opposed to themes.
Okay.
I do talk about themes so that a lot of LPs or a lot of our counterparts within the industry think about thematic investments.
For sure.
Whereas one thing that's very important for us is we try to invest in post-product stages, early commercialization. So we take commercial risk, but not a lot of product risk.
Okay.
And there's a very particular reason for that. What we're observing is the sales cycles in industrial tech, or sometimes product development cycles, can be really long.
Can you define, I'm always curious when people say long, because people have different time references. What does really long mean for you?
Look, it could be a SaaS company that will take a year easily to actually sell to an industrial corporate, if not longer, sometimes 1.5 years when you're first getting started. And what we thought we would try to do is, by activating the industrial networks we built over our careers and continue to build around the funds, we thought we would try to accelerate the commercialization efforts of our portfolio companies.
Okay.
So there's, and we do it in three ways actually. Like the investment team, you've heard my background a little bit, but my partner also comes from a very industrial background. So we have certain networks, and then we have a soft advisory panel around us that includes some C-level people from, let me not say their names, but like large automotive and aerospace and defense companies, construction groups,
people for whom your investments might be relevant.
Precisely.
Or open doors for
and
them.
They act on a personal capacity, which is why I refrain from saying the company name. But large OEMs whose networks we can tap into. And then our investor base, while there are some purely financial investors within our investor base, there are also a lot of investors that come from industry that are with industrial links, like family offices with underlying industrial assets, or senior executives in industrial groups. Recently, we got a commitment from an automotive OEM. So we try to also tap into these type of networks to quickly connect the startups we invest in and hopefully open doors for them, like from a commercial perspective.
Okay. So that's the decarbonization element. And
sorry, I just realized I didn't quite answer your timeline thing. So for digital technologies, it could be like up to a year and a half that initial sales cycle. Obviously, your goal is to shrink that as much as possible. And for decarbonization, and this is the challenge for funds like us, if it's like a physical technology, then you go through different TRL levels, which takes years. And the challenge for us is not all. We're not a multi-stage fund, and not everything is suitable for us.
And it's, it's at odds oftentimes with the venture capital structure, right?
Yeah.
There is a fund that needs to be returned in 10 years. Maybe you get another 2 years, so you have 12 years, and you can't make a bet into a company that's starting their development cycle and you're in year 5 of your deployment. Like they need more time. And so obviously it's difficult. I guess to that point, having worked with industrials and conglomerates that are focusing on this areas within the CVC and then working on a fund, do you think that there maybe are more advantages that can be leveraged from these industrial companies that have longer time horizons compared to sort of VCs that are constricted by these 10 to 12 year timeframes?
You mean as a corporate VC investor?
As a corporate VC investor, specifically in this industry, not in all industries, but as we think about these things that, like you said, sales cycle are long.
Yeah. So I agree. If you're not constrained by the typical fund cycles, then you can take a longer term view. You can also explore other types of partnerships. The challenge with being a corporate investor is sometimes, in my opinion, you got to set your strategy right and like understand why you're doing this. Some are very strategic. Some are there to make money, or so they say, and some are there to bring innovation into their ecosystems by doing investments and so on. So if you're there's a very specific reason why we go to post-product companies, because corporates often struggle to interact with startups that don't have a product.
For sure.
Yeah, I mean, and I completely understand.
I work for a CVC and I know that experience very well.
So coming back to the decarbonization angle, what I'm observing, for example, is you get a lot of these large oil and gas type of companies going into carbon capture, hydrogen, etc. But typically at Series A, B onwards, where there's actually a product and like actual market demonstration where you can get real data, etc. Whereas like slightly earlier stages are still covered by a lot of decarbonization funds.
Yeah.
So I feel like corporates are more interested in getting involved slightly later, but they can take the longer view.
Which makes sense. Yeah, they can. But again, oftentimes these ideas take a lot of capital to get off the ground.
Yeah.
And that's something I'm curious as to how do you look at the space and the needs of like funding needs of many of the companies that are operating within your thesis, because, it's not generally a B2B SaaS company that, you can throw 200, 300, 500K at and they're going to be fine to have 18 months runway.
Yeah.
It's people that require testing, they're doing production, they might have manufacturing needs, or they might be interfacing, with people who have a 18-month sales cycle, as you mentioned. So how do they capitalize themselves in a way that prepares them for that long journey?
So there's a few things. There's a distinction that we try to do when we think about hardware-related companies. So there is your decarbonization type of opportunities, which often require a first-of-a-kind facility, perhaps.
Right.
Then there are some companies that are hardware-enabled. They take off-the-shelf hardware.
Yeah.
And then there are some companies that are actually building something bespoke hardware.
Okay.
I think this third bucket is probably the most difficult one to fund, because, we're not trying to swim against the current here. Like there's a lot of downstream investors when you invest in decarbonization. So there's early stage investors, the supply chain, like the investment ecosystem is there. Like there's Series A investors, corporates,
and there's a lot of, as we say, dry powder waiting to be deployed.
So I think that bucket is suitable to invest in even as a small fund like ours.
Okay.
Or an early stage investor. Hardware enabled companies, they take off the shelf hardware, and more even like robotic solutions are becoming more affordable.
I speak with like drone or robotics companies on a weekly basis, and they're always like, we're not building this thing from scratch. We have these components, and we're able to build it cheaper. We're not going to buy it off the shelf because it's 45-50% more expensive to do it. So we're building it ourselves.
So and this is what I'm talking about. Like sometimes buying off the shelf stuff, it can be quite effective, and the magic is mostly in the software they develop on it, right? And we also find those types of propositions a bit more appealing from a funding perspective. And there's, again, more and more investors are open to these kinds of things. Which brings me to the third point. Sometimes we come across companies that build a bespoke piece of hardware, like an industrial wearable, or, like a robot, but like that's a bit funky and like everything needs to be built in-house, etc.
Yeah.
And those kinds of things, they're not very suitable for us. And I also find that it's a little bit trickier to fund when you go to Series A investors, etc. Because the perception is that's really capital intensive. And
can you give me an example of like what that might? You said like a robot is. What else would you? What kind of companies have you come across that you feel like fall into that category?
So, like I said, I've come across a few wearable type of devices, which can be in that space, like funky helmets that measure your brain waves and stuff like that. Like, you could argue that they're not very expensive, but it's quite bespoke, right? And then you need to find a very particular type of investor that is willing to back that company down the line, or maybe less industrial, but like all these sort of like. At some point, I remember this like juice company that came up with their like juice device. Do you remember? And
was it the one that it's like they literally were just pressing bags of juice out? Yeah.
Something like that. So, like these kinds of like devices that are a bit more bespoke. Yeah, sometimes it takes off, but more often than not, you do need quite a bit of capital to set up the sort of assembly
and the supply chain. For sure. To sort of shift a little bit and talk about the kinds of companies that you all have in your portfolio, where have you felt most comfortable? You said earlier about sort of 3 areas where you felt comfortable taking bets. Like what are some of the things that you all are looking at now, and what are some of the successes that you feel like you've been seeing in your portfolio?
Okay, let me and we touched upon decarbonization. By the way, we did invest in a sort of like a physical decarbonization type of company as well. So it's not that we don't do it.
But it's not the bulk of your investment.
Exactly. Yeah. The bulk of them have been in industrial AI and robotic automation. Maybe let me start with robotic automation. When I first started looking at industrial tech at the first CVC, any robotic solution we would come across back then, maybe I'm exaggerating, but it would cost 150, 200 grand.
Just to get what?
The robot.
The base, the like
this
V1.
Was 8-9 years ago. Yeah, or V2, whatever. But like you'd ask them how much it would cost, 200 grand.
Okay.
Right? And today, we come across a lot of robotic companies that are that have bill of materials in the 10 to 20 grand range. So that's a 10x improvement.
Okay.
Add to that how much smarter the software has become. Like computer vision as well as like just the general software on
them. The chips as well are more advanced.
Exactly. So it's much faster, and then that makes the hardware more able as well. So suddenly you're, rather than like a 200 grand piece of robots, you're looking at a 15, 20 grand bill of materials. And that becomes much more interesting to replace human labor in like a lot of industrial domains. And then you can start actually utilizing some different business models that would have been very difficult back then. Like, so hardware as a service, if your bill of materials is 15 grand, then, let's say you could rent it out for 2,500-3,000, which is almost like a direct replacement from a salary perspective. Whereas if it's a 200 grand piece of robot, that's not the price point you aim for.
Okay.
So I think the robotics part is becoming very interesting from that perspective. Still, 70% of everything manufactured is manufactured by human labor in industry.
So when you talk about robots, I think people have a lot of different understandings of what robots are. I think, for the general public, when you say robots, they're thinking of like these humanoid, Boston Robotics types of things. For people who are, maybe in an industrial space, they might be thinking of robotic arms or pieces that help with the manufacturing process.
Yeah.
If you talk to, other kinds of industrial people, maybe they're thinking about things that actually just work autonomously on their own, but maybe don't necessarily build things, but just sort of help with a particular process. How do you all sort of identify or think about opportunities within robotics for the industrial space? Is it more of this sort of second category of like tools for manufacturing, or do you look at it
we have 2 or 3 companies we've invested in the space. For example, Finext is a middleware company, and they focus on orchestrating mobile robots. You could be in a third-party logistics center. There's robots that bring shelves to people, or you could be in a warehouse or a factory type of setup. You could have autonomous forklifts or AMRs and those kinds of things. So, for example, Finext focuses on that. That's a middleware solution. We do have another software investment, Fuzzy Logic in France. Although that's not public yet, so it's on our website.
How long does it take? How long will it before?
They haven't made the press release.
This won't happen until November.
Yeah, exactly. So Fuzzy Logic, it's a SaaS solution, software only, but they are a universal programming and operating software for robotic arms. So more static robots in an industrial manufacturing space. And robotic arms, if you think about it, you could use them for like pick and place type of use cases, which is what most of the industry or most, I guess, a lot of our use cases focus on. But then there's also these trajectory type of applications like welding, lasers, or polishing and those kinds of things. And Fuzzy Logic's software feels like quite appropriate to enable those kinds of use cases. And then we also have a very sort of like specific verticalized application that we invest in with Zano. They take off-the-shelf robots and they use them for fruit packing purposes. So the punnets of tomatoes or grapes that you buy in the supermarket, normally they're being packed by human operators, laborers in a pack house. And those pack houses have actually a conveyor belt where the fruits are just like flowing, and then they pick it up and put it in the punnet. So they've essentially replicated that use case. The magic is they built first a computer vision model so that the robot can understand and estimate the weight of the tomatoes or grapes, yada yada. But also there's an electronic skin that they've developed which enables robots to handle the fruits without crushing them. So most of the value add is, because they take off-the-shelf robots, actually most of the value add is on the software and the electronic skin side of things. So again, we're trying to take sort of like sensible bets in different parts of the robotic value chain. That seems like a big theme for us. That we've also seen a few solutions out there that are quite interesting. Like there's a company in Germany called Kewazo. They make these like vertical robots, so for like scaffolding type of applications. And you start out by sort of like automating how you take the equipment up the scaffold, etc., etc. But suddenly, once you digitalize that process, you can start keeping track of all the materials that go up and down, and like you can start sort of doing analytics on it, which normally would not be possible if it's just human operators that are taking things up and so on.
To do that.
Yeah, or there are also some specific use cases. Like we've recently seen a company which is doing these robotic arm programming type of solutions, but using LLMs and so on as well. So rather than programming it, you literally tell the robot to take this mic and move it there, and the robot, there's quite a lot of like physical world simulation behind it, but the robot can therefore understand what you're saying without you having to specifically program it, which I thought was really cool.
Interesting. With respect to like what's sort of next in terms of the investment thesis, are there any areas that you find to be or seeing a lot of activity in that you think is interesting and worthwhile to place bets in the coming sort of 6 to 12 months?
Yeah. Look, I mean, a bit of a boring repetition perhaps, but of course, AI is really disrupting a lot of these industries, and actually there's a lot of interest from corporates into bringing AI solutions into their ecosystems as well. And there's no sort of single application of AI into industry. A lot of focus recently has been on Gen AI or like LLMs and so on as well. But I think it's important to highlight that in industry, other types of AI technologies are quite common. So like more based on data like
analysis,
numerical data analysis and so on as well. But nevertheless, the recent wave has, I think, made a lot of corporates more open to bringing these systems into their sort of like production lines and so on. On our side, there are a couple companies we've been actively looking at, both at the intersection of AI and energy/decarbonization. So how do you use AI to optimize energy use in heavy industries? They're like big emitters after all, like glass manufacturing, cement, ceramics, etc. And they use a lot of energy to heat materials up. So could you use AI to optimize that? And if you did, if it leads to 2, 3, 4% savings, that's actually a huge amount of savings in terms of decarbonization effect and also to the bottom line of these companies. So there's a few things like that that we've been looking at, which seem interesting and exciting. So right now, I think in the next 6 months, probably the focus is a bit more on that side.
Okay. So you've had such an interesting career being able to sort of see both startups who are operating and wanting to change the space, but also being able to see the corporate side of things and see how things work in the back end for these giants that have been working for a long time. And what do you think are some of the biggest challenges for startups that are seeking to disrupt the space or bring innovation? Maybe not disruption is the word we always use, but maybe just like bring innovation to the space to make it more efficient, to make it more, to make it greener. What do you see as opportunities there?
Look, earlier we discussed the whole sales timelines, right? Yeah. And there's actually a reason for that, or for the most part. Industrial corporates, they're trying to maximize the uptime of their assets, right? So they're very wary of bringing in a new, let's say, unproven, untested technology, which could sort of like disrupt their production or break things even worse, right? So they tend to be, or at least by my observation, they tend to be quite risk averse, which is leading to those initial long timelines.
For sure. They need to know that the product works.
Of course. And it's not just a matter of, I manufacture this today. Like you buy a car from a German automotive OEM, it'll last you decades. Yeah. Whereas, you may have seen Tesla, which is quite and Tesla is more like a startup type of approach, right? So you get these situations where you could manufacture today, but is it actually going to really last as per their standards? Or is it going to meet the safety and regulatory standards? I know people tend to complain about Europe over-regulating, etc., but it is part of life. These things need to be robust under different conditions. They need to be safe to be used by industrial partners or end users.
And they need to be, in order to do both of those things, they need to be tested, right? Which means that there needs to be infrastructure in place to allow for that.
Exactly. So let's imagine a situation where, for the sake of the argument, you think of a a generative AI solution which is coming up with these funky designs, and you're like, wow, this looks cool, I use less material, etc. And maybe you do stress testing, etc. as an engineer, but like it could be that you still need a bit of real life sort of like proof points until you really start manufacturing at mass scale. So and that takes a bit of time to begin with. I think that's probably the main challenge of getting into industrial domains. But once you do that, which brings me to a point I wanted to make about industrial tech VC as a separate piece in the VC asset class. I think that gives a different kind of nature to the companies that we invest in, which we can talk about in a bit.
Yeah, no, look, expand on that idea. What exactly do you want to say
so
about
I
it?
think I know you were asking me about this earlier, that's why I wanted to keep it for later, but basically what we're observing is, yes, it's more difficult to get into these industrial corporates, but obviously once you get in, it becomes really sticky.
Yeah.
And at least based on our track record, and I can't fully talk for the market track record, but we see a much higher survival rate of these companies, even when you invest in like the early stages for the last 8-9 years, which we've been doing. We've got over 90% survival rate in the companies we've invested in, which you would expect.
For venture, that's very rare.
Yeah. But the flip side is you don't see this explosive B2C type of growth.
Yeah.
2/3 of them have received follow-on funding. So the way I interpret it is it becomes part of the workflow. Customers continue to use it. There's a steady growth over time. And at some point, other investors become interested in it when it becomes of a certain scale. It's still growing fast, but it's not hyper growth.
Yeah, it's not hockey stick growth that I think many venture investors tend to look for when they make investments, but it's more growing really steady, profitable, generally businesses that have opportunity to be around for a long time.
Yeah, so this is what we're observing. So it just makes me think that industrial VC could offer a different risk reward profile compared to the VC asset class in general. I'm not saying power laws don't apply. You still have like big winners and stuff, but like the flips, there's two aspects to the power laws, right? Like the winners get a lot of money and you have a long tail of losers. And especially if you think about the long tail of losers, maybe that's not quite prevalent for industrial tech companies. Maybe more of them survive.
Yeah, they don't become the massive winners, but they're in that sort of sharp decline that is, you know, at not quite the mega winners, but not in the loser realm either.
This is something that's a bit unusual about industrial tech that I observe. But granted, it's based on a limited sample size.
I think the sample size is quite large. Now we're going to get into our section where we ask you a set of rapid fire questions about the industrial space and about your experience. So are you ready?
All right, let's give it a try.
What's one startup trend that you're tired of hearing about?
Predictive maintenance. I think there's a market for it, but by now it's super crowded. So very difficult to, even if a company is using something really innovative, it's very difficult to differentiate yourself out of the amongst all the crowd and the noise.
What's the most overrated industry for investment right now?
Again, not to sound like I'm dissing a certain segment, but I think the whole hydrogen space is a bit overrated.
Interesting.
Because here's my thinking. I by the way, I'm a big believer of sort of like hydrogen playing a solution within the decarbonization space. But I think people will realize that probably the addressable use cases may be a bit smaller than what initially people were expecting.
And what do you think those use cases are?
Probably more focused on, of course, heavy industries and maybe using it to create synthetic fuels, etc. But I don't think it's going to happen in automotive, for example, which you just lose too much along the way in terms of electrolyzer, etc. So it's not as efficient for a lot of use cases. Even for heavy trucks and stuff, people were thinking, okay, maybe hydrogen will be useful there. but a lot of them are still going for electrification, like batteries and so on.
For sure. What's a green flag when you meet a founder?
Strong communication skills, concise communication skills. In industry, I think it's difficult to explain some of these scientific concepts. And I always ask them if they could explain it to me in layman's terms. Because if they can, then it's easy for them to also sell to a sales guy who is not necessarily scientific. And I really appreciate that skill.
If you had to start a business tomorrow, what would it be?
An AI agent that is a VC analyst. So look, our job is all about handling information.
Mm-hmm.
So yes, like of course we use our brain, we do analysis, etc. But at the end of the day, you get a lot of decks, you send back and forth a lot of emails. You can now actually record conversations like those AI note takers on Zoom, etc. So you suddenly start collecting a lot of verbal information, which you can then use an AI agent to automate a lot of processes.
Very true.
It's actually a side project we're doing with a friend of mine.
Ooh, when it's ready, let me know.
All right, let's see if it works.
What's a book every aspiring founder should read?
Rather than a specific book, I think people should be reading more fiction. I think a lot of people are focused on, self-improvement books, which is fine. I get that, but I come across a lot of people that need to increase their EQ, frankly. And if you read fiction, you start sort of understanding people, the world better. You can improve your EQ. You can you can be more empathetic and so on. So, and frankly, it's a good way of giving a break from all the work-related things. So I try to read more fiction these days.
I love that. What's a founder ick that turns you off in meeting a founder?
Yeah, getting argumentative and too defensive. If I can elaborate, look, of course, our job is to evaluate a business, right? Yeah. But that doesn't mean you should take it personally. And sometimes, with the best intentions, we can give some feedback.
Yeah.
So the way they take it can be quite a good indicator of whether actually you can work with them, but also about it's an indication about their character as well.
At our last firm, we called it coachability.
Yeah.
What's the first thing you look at in a pitch deck?
Again, rather than a specific thing, I feel like by now, because I've seen a few thousand pitch decks over my VC career, it feels like sometimes I can tell whether a company looks like a startup and they have that VC mindset versus a company that looks like an old school business, which will be very difficult to get into the VC mindset. Yeah. And I think this is important for founders to understand. Yes, there's an sort of an emotional side of VC. People talk about supporting founders, etc., which is great. We like that. However, we're also in it to make money.
Yeah.
And you want a certain mindset from the founders to be able to, join you on that same path, the VC path, right? So I think from the deck, I can tell a little bit, it feels like, whether they have that mindset or not.
And my last question, what's a common belief in the industrial industry that you think might be wrong?
Well, this is what I was touching upon earlier. I think the whole power law returns for VC. It's general for the broader market, but I suspect it may be slightly different for industrial tech VC investments.
Well, Duran, thank you so much for taking time to share your experience with us and to chat with us about your portfolio and about the journey related to industrial tech, your journey specifically related to industrial tech. And we're looking forward to seeing what happens next with Atlas Ventures and the companies in your portfolio.
Thank you so much for having me today. Actually, I realized that time literally flew. So clearly I was enjoying myself. Thank you.
Me too.